What is going on, everybody? In today's video, I'm going to be going over 5 different facts you should know about home equity lines of credit, also known as a HELOC. So if you give me about 10 minutes in this video, I'm pretty much going to cover it all. I'm also going to touch on some pros and cons and additional information as well. So let's jump into it. So to start with, just a little background on me in terms of my HELOC experience. I have about a 6-figure HELOC right now with one of my properties, and I'm working on getting additional HELOCs for several other properties that I own as well. What exactly is a HELOC? It's basically just a revolving line of credit tied against your house. So you can use it if you want, but you don't have to use it. It's always going to be there. And the way the bank comes up with this number, if you're even qualified for a HELOC, is that they'll take 85% of the appraised value. They'll do their own appraisal, do 85% of that, and then subtract that from your mortgage, and that's potentially how much you could get for a HELOC. Now, different banks have different requirements, and some banks also have a maximum of how much they're going to lend. So you might not be able to get like a $500,000 HELOC. You know, a lot of times they might have like a $150,000 maximum, maybe a $200,000 maximum, but there is a limit to how much equity you can access. And another thing to know about HELOCs is that this is great if it's your primary residence. If it's an investment property, some banks might not even do a HELOC for those types of properties. And the banks that do are going to be much more strict. So instead of 85% of the value, it's probably going to be more like 60 or 65%, maybe as high as 70%, you know, if you really call around and, you know, reach out to like 20 or 30 different local lenders. Now, the way the process works for actually getting a HELOC, it's kind of similar to a standard mortgage application. However, the bank or credit union is going to ask you for significantly less documents. They'll still probably ask you for tax returns and things like that, but it's not going to be as involved as applying for a mortgage. And once you submit the documents, the process usually takes about 45 to 60 days for the bank or local lender to approve the HELOC. So at some point during those 45 to 60 days, they're going to send an appraiser out. Sometimes they can just do an automatic appraisal, just, you know, based on their evaluations. And that's actually what they did for my property. So an appraiser actually didn't even need to go out. They just had some type of, you know, computer evaluation they did and got an appraisal from that, and then took 85% of that, subtracted it from my mortgage, and that's what I was able to get. So one of the main things to know about getting a HELOC is that you should kind of shop around and find out who offers the best rates, the best terms, different things like that, because some banks, they might only give you like 70%, whereas other banks may go as high as 85 or maybe even 90% in terms of the ARV. So what you can do is you can go on different Facebook groups, and a lot of times people will have questions. If you're in like real estate investing Facebook groups, people will be asking, you know, who has the best HELOC rates, that type of thing. You can also ask just your local mortgage lender, and oftentimes they might get a HELOC from a completely different company. You know, one of my top lenders, he gets his HELOCs, or his one HELOC, you know, from an entirely different lender. So I would try to come up with a list of maybe like 5 or so local lenders. Credit unions are pretty good for HELOCs. You know, this is like the one scenario where I would recommend working with a credit union. In the real estate industry, they have a reputation for being fairly slow and, you know, not really closing deals in 30 days. However, with a HELOC, chances are you have you know, more than 30 days to get it done. So it's usually not that time sensitive. And credit unions can offer great rates. You know, they can offer great personal lines of credit, HELOCs, car loans, you know, refinancing, that type of thing. I just wouldn't recommend going with a credit union if you're making offers on properties and you need to get it closed in like 30 to 45 days. The second thing you need to know about HELOCs is that, at least in my opinion, there's no reason not to get one. So if you have a lot of equity in your property, you can access that equity or you don't have to. But a HELOC gives you that option. You don't have to spend any money in your HELOC. You can just have it there for emergency funds or for whatever you may need. So you can kind of use it as like an emergency source of funds. Maybe you lose your job, something happens, you're moving, you're traveling, whatever it is. You can just have access to that. If you wait too long and then you need the money all of a sudden, it's going to be much tougher to just get a HELOC in a short period of time. So just use it as like a source of reserves if you want to. The fees and costs associated with getting a HELOC and maintaining your HELOC are usually pretty low. You know, I think I pay maybe $100 or a few $100s per year to have access to basically $100,000 of pretty much liquid cash that I can access at any time. So I think it's a pretty good return. Number 3, you can use your HELOC for just about anything. There might be some fine print with some lenders that says, you know, you can't use your HELOC for this or that, but Generally speaking, you can use your HELOC for just about anything because it's tied to the equity in your house. So why would the bank care, what you're using it for? And some of the most common things that people use a HELOC for, including myself, you could do renovations on your property to increase the value. You could also use it as a down payment to purchase maybe a larger property, a larger investment property, or maybe just a larger primary residence. Some people use HELOCs to pay down high interest credit card debt or other types of, maybe student loans. Because the thing about HELOCs, the interest rate is usually about 4 to 5%. So if you're paying credit card interest of, 15 or 20%, that could be pretty beneficial to you. I've even heard of some people using their entire HELOC to pay down the principal of their primary residence mortgage. And there's actually a book out there, it's called, I think, How to Pay Your Mortgage Off in 5 Years. And basically the entire book in a nutshell is to get a HELOC of, let's say, 50 or 100,000, use that entire money to pay down, put it towards the principal payment on your mortgage, and then use your job or source of income to pay down that 50 or 100,000 that you've just put towards your principal payment from the HELOC, and then reapply for a new HELOC, given that you might be able to double the size of that HELOC, and then just basically repeat that process where you now take, let's say, $100,000 or maybe even up to $200,000 of your HELOC, put it down towards your principal payment on your mortgage, and within 5 years you could theoretically pay off your house. So basically there's a lot of different things you can use for it. What I would not recommend is buying like boats, new cars, vacations. That's how a lot of people got in trouble in 2007. They were just basically using their house as like a credit card, as an ATM machine. So you definitely, you got to be careful with the leverage. You don't want to over leverage yourself or put you in any type of like dangerous situation financially. The fourth thing to know, which I briefly touched on, is that it's going to be significantly harder to get a HELOC on an investment property. However, there are plenty of lenders that will do that for an investment property. You just need to make sure you have a lot of equity in that property and that you find the right lender. There are credit unions, I think including PenFed, that will lend up to 70% of the appraised value, subtracted from your mortgage for investment properties. So that's definitely one option, and you can shop around to find some other ones. But I also think their underwriting for these investment properties is a lot stricter. So if you try to get a HELOC on an investment property, make sure the curb appeal when the appraiser goes out there is just like immaculate, so that there's no question as to the value, because they're a little bit more conservative with these investment types of HELOCs. The fifth thing to know is that getting the HELOC is going to help your credit score. It's going to be a new source of debt. It's also going to help your utilization rate. So when I add 100,000 to my utilization rate, assuming that I'm not maximizing that 100,000 and I'm just keeping it there as like kind of a reserves or maybe as a down payment, that's going to help my utilization rate quite significantly, as I'm sure it would you as well. So it's going to help your credit score so long as you make the payments if you use it and you use it responsibly. So if you have any questions about HELOCs, drop them in the comment section below. I'll be sure to personally respond to every reasonable comment. And watch this video right here, and I'll see you in the next one. Bye.